Germany's business outlook improved for a third month in November, pointing to an impending recovery, perhaps, for an economy that is probably in recession now and beset by a budget crisis. The IFO Institute's gauge of expectations rose to a 6-month high of 85.2. It was less than economists had expected and less than the Bloomberg survey, but still a tick upwards. Joining us now is the IFO president, Clemens Fuest. Welcome back to the programme. Thank you so much for joining us again. Is the worst of Germany's economic downturn now definitely behind us, do you think?
Maybe it's too early to say it's definitely behind us, but it's certainly a stabilization. It's a stabilization at a low level, but a stabilization we expected. I would say it's driven by interest rates probably having peaked. It's driven by energy prices easing. We see that in manufacturing, for instance, in particular, the energy-intensive companies that were so affected by energy prices, they are now telling us things are improving. So it seems that the hope for an easing of energy prices and generally an easing of inflation and lower interest rates are driving this stabilization.
Okay, that's interesting. So energy prices and interest rates, and you're seeing that improvement already in terms of energy prices. What is the expectation then around interest rate cuts? Because ECB officials continue to stick to the mantra of higher for longer. Interest rates are at 4% across the Eurozone. Inflation is at 2.9%. Has the ECB gone too far? What are you hearing from businesses?
I wouldn't say they've gone too far, but in markets, we just see the expectation that interest rates will be falling next year. And I think it's understandable that the central bank signals it's ready to increase rates further if necessary. But markets seem to think it won't be necessary. The economy is slow. Yes, there is some recovery, but there is no big boom. Energy prices are coming down, and that suggests inflation will also be easing further. And that would create room, maybe in the second half of 24, for interest rate cuts. Of course, for the central bank, it's too early to talk about that, but that's what markets expect.
Yeah, absolutely. Phil was saying the ECB won't raise rates again. The issue, though, is whether there is a risk of inflation surging once more. That's the kind of trepidation that the ECB has.
Yes, and I think for them it's important to stabilize expectations. And indeed, there are risks. For instance, if there was a change in the situation on energy markets, or if we take into account that wages are rising more quickly now, that may affect prices, in particular in the service industry. So there is certainly, there is no certainty that inflation will come down, and the central bank tries to maintain expectations stable by saying, if necessary, we will increase interest rates further. Nevertheless, the main scenario and what we see implicit in futures prices in financial markets is, yes, interest rates have peaked, inflation will come down. And I think that's what's part of the story why the German economy seems to be stabilizing.
We're very used, Clemens, good morning. We're very used to budget chaos here in the UK, thanks to our former Prime Minister Liz Truss. You are facing budget chaos now in Germany. The debt cap is being lifted for the fourth time this year. Mr. Lindner must be gritting his teeth over that one. What is the potential economic impact as the German coalition wrestles with this budget and the changes that have to come through as a result of this ruling that seemed to take so many by surprise?
Certainly, this creates more uncertainty and about future subsidies and policies around the energy transition, around infrastructure investments. And a lot of businesses will now wait and see what the government does. The real challenge is the 2024 budget. There is something like a 35 billion hole at the moment.
Wow.
And how can that be filled? That's what the government is struggling with. It will be very hard to declare another emergency next year. year. The government will have to be creative there. There are some options like using public companies to incur debt. Maybe some of the subsidies can be postponed. Some of them are maybe unnecessary. So there's debate about the 10 billion subsidy for the Intel plant in Magdeburg, for instance. But this whole thing certainly has a dampening effect on an economy which is already relatively weak.
Yes, absolutely. We were looking at the PMI figures for November only yesterday. Manufacturing and services figures improving on the mend, but they still do highlight the difficulties. Do you see a continuing improving trend, though, for the PMIs? Perhaps what's the next data point that you'll be watching?
We do expect this recovery to continue, but an important factor will be how these budget negotiations are continuing. There are options. For instance, the government could sit down with the opposition and suggest a solution similar to the Armed Forces Special Fund that was created. It was enshrined in the Constitution, a bit unusual maybe, but a solid way of doing this, a solid legal basis, and the government could do that with the investments in infrastructure and energy transition. And I think that would give a boost to private investment in this area also. The big question is, is it realistic politically to get to such an agreement? It's certainly early days to say that. If that doesn't work, I think the budget situation will negatively affect growth next year.
Okay. IFO President Clemens Fuest, always appreciate your time and your insights on this German economy. Thank you very much indeed.